I suggest using at least 2 time frames when looking for entries. A higher time frame zone allows you to anticipate new, smaller time frame zones that will be more reliable than the zones opposing them. This chart represents higher time frame supply. I used the 4-hour for higher time frame zones and the 5-minute chart for entry. If you were to use a daily chart for your higher time frame, you could use a 30-minute chart for entry, and if you were using the weekly chart for your higher time frame, you could use the 3 to 4 hour chart for entry. This chart represents smaller time frame zones appearing after encountering higher time frame supply. The green areas represent where I'd place my entry order, and my stop would go slightly past the other side of that zone. This chart represents higher time frame demand. This one shows smaller time frame demand appearing after encountering that higher time frame demand. After you've identified a higher time frame zone and have observed fresh, smaller time frame zones forming after coming into contact with that zone, the last consideration before entry is profit margin. Profit margin is the distance between your entry and the next opposing supply or demand zone. You want to take profit before that next zone. I won't take a trade if my profit margin is less than my risk, and ideally profit margin is going to be several times my risk.